Hi everyone, I'm Cara Santoro and I'm in Cummings and Lockwood's Stamford office.
I'm Stefania Bartlett, also of the Stamford office. Cara and I have the pleasure of speaking to you this morning about the point in time when your clients have accumulated enough wealth that they're ready to implement a charitable giving plan. We'll give you a brief overview of the tax framework behind charitable giving and then discuss various charitable giving techniques in more detail. The first slide is a simple chart that shows the various income tax deductions available to an individual for charitable contributions. The deduction is really going to depend on a number of factors. So first, the recipient charity. Is it a private foundation, a public charity, or some other charitable entity, like a private operating foundation? It will also depend on the property that's contributed, whether it's cash, ordinary income property, or capital gain property. The deduction will also depend on whether the donor has contributed his entire interest in the property or has created some sort of split interest vehicle. And then lastly, the deduction depends on other charitable contributions the donor has made within the same year. There are various percentage limitations depending on the factors I just listed. And if an individual maxes out that amount in a given year, then there generally is a 5-year carry forward. Clients must itemize their deductions in order to take advantage of the charitable deduction. And as we all know, the standard deduction was increased in 2018. So for clients who might be on the line of taking a standard deduction or itemizing this year, they may be motivated to gift charitably. Other clients may want to bunch or stack multiple years' worth of gifts in 1 year so that they can itemize. And then there'll be those other clients that are going to gift regardless of deductions. So think of your client that's giving to his local food bank during the holiday season. An individual's annual deduction is capped at 50% of his adjusted gross income, or AGI, and that cap can be reached in a variety of different ways. You can mix and match the various gifting techniques that we're going to discuss today. Before we get into that, Cara is going to discuss a new percentage limitation for 2018.
Starting in 2018, Congress increased the percentage limitation to 60% for charitable income tax deductions. We all hoped that the mixing and matching that Stefania just talked about would apply to this 60% adjusted gross income limitation. However, unfortunately, the way the statute is worded right now, it does not. And so in order to take advantage of this higher percentage limitation, a client would need to contribute at least 50% of their adjusted gross income in cash to a public charity, and this includes donor-advised funds, in order to take advantage of this higher percentage limitation. So an example is probably the best way to show how this new limitation works. So say you have a client who makes $100,000 in 2018. And they want to give $55,000 or 55% of their adjusted gross income to their alma mater in cash. They also want to give $5,000 worth of stock to that same alma mater. So that's 5% of their adjusted gross income. So your client asks you, can I take a $60,000 deduction for my charitable contribution this year? The answer is no. The client can only take a $55,000 deduction this year for the cash gift, and that $5,000 stock gift has to be carried forward. So we're hoping that Congress might change this. It's this coordination rule, and there are proposals to change it, but so far, the way the statute is worded, it really makes it a narrow limitation. So the important takeaway is that this might not be as widely used as we thought it would be.
In addition to income tax benefits, individuals may receive other benefits for charitable contributions, and trusts and estates may also receive benefits for charitable distributions. There's an unlimited estate tax deduction and an unlimited gift tax deduction for bequests and gifts passing to charity. This includes foreign charities and governmental entities. Trusts and estates may also receive an unlimited income tax charitable deduction if certain technical requirements are met. I mention these deductions because they're important to keep in mind as we discuss various gifting strategies, and they might help a client determine what makes the most sense. So now that we've given you a brief overview of the tax framework, we'll review various gifting strategies in more detail, beginning with outright gifts.
The simplest way to give is outright. And this is either during a client's lifetime or at their death. When a client wants to give outright at their death, In addition to the estate tax benefits that they might receive, it's a really great way for a client to use their assets during their lifetime for themselves and their family, and then create a legacy for their family when they die. Also, during lifetime, if a client wants to make lifetime gifts, outright gifts are really great because in addition to the income and gift tax benefits that they might receive, it's really a great personal thing for a client to be able to have a relationship with that charity. So a client might want to give year after year to the same charity, become personally involved with that charity. So for example, I know a survivor of cancer, and each year she gives to this particular cancer research organization. She participates in their annual 5K walk. She fundraises for them, and she's an active spokesperson for them. And so it's become a really important part of her life. And so in addition to a lot of the great tax benefits that a donor can get from outright giving, there are also a lot of other benefits to be had. And one really great tool that a client can use for outright gifts is the IRA charitable rollover. So this is great for an older client who has charitable goals and maybe has a sizable IRA where they need to start taking their distributions. Now, how this charitable rollover works is that the distribution goes directly from the IRA to a qualified public charity, and the client can exclude that entire distribution from their income. Now, this is really great because if we think in the alternative, say the client took the IRA distribution, put it in their bank account, and then decided in that same year to give that same amount to charity, they'd have to include that amount in their income. That charitable deduction would be subject to all of the percentage limitations that we talked about for federal income tax purposes, and in certain states, they might not be able to offset their income either. So for example, if you have a Connecticut client, Connecticut doesn't have a charitable income tax deduction, and so they'd be out of pocket for those Connecticut state taxes. So this is a really great tool for clients with IRAs, and this applies for both federal income tax purposes and state income tax purposes in all states except for New Jersey. So the one catch with this is that the distribution has to be made directly to a qualified public charity. So what does this mean? It means you cannot make a distribution to a donor advised fund, you cannot make a distribution to a sponsoring organization, and private foundations are also excluded.
Some clients prefer to make gifts and direct the use of the gift for a specific purpose. So for example, you may have a client that wants to gift to his alma mater, but he wants to establish a fund, so he knows that the fund is used exclusively for scholarships or for the creation of a coaching position or for some other specific purpose. For these clients, we recommend the use of a fund agreement or a gift agreement as a way to formalize their intentions. It's also a way to hold a charity accountable because the charity can issue reports so that the client is aware that the funds are being used as intended. But we do remind clients to be mindful of the restrictions that they place on gifts because they could lead to a charity rejecting a gift. So take, for example, a client who wants to donate a piece of art to a charitable organization. If the client is going to place restrictions, such as the amount of insurance that must be kept on that piece of art, or that the art must be stored in a certain manner, or maybe that the art has to be permanently displayed, this might become too costly in the eyes of the charity, and if the charity rejects the gift, then neither the charity nor the donor has received a benefit. Agreements can also be used to address donor recognition and naming rights. Some clients really like this idea because it's an opportunity to promote their legacy or honor a loved one. But when discussing naming rights with clients, it's important to discuss the length and the terms of these rights. Earlier this year, we had a client who gifted funds to a university for the construction of a dormitory, and he really liked the idea of having his name placed on the building. But we had to counsel him to consider what would happen if the building needed to be renovated or if it was destroyed in the future. Did he no longer care about his naming rights, or did he want the right of first refusal to be able to donate more funds and have his name added to another building? On the other end of the spectrum, we have clients who don't want any type of public acknowledgement. Maybe because they don't want to be known for publicly supporting a charity, even though they support the charity for political or religious or other reasons. Or maybe because they don't want the charity to use their name when they're soliciting other donors. In either of these cases, agreements can set forth how the charity will recognize a donor. The greatest takeaway with respect to this tool is just making sure that your client thinks through all of these issues before any agreement is drafted, and definitely before any type of agreement or pledge is signed.
Another great charitable planning tool that probably a lot of you in this room are familiar with is a donor-advised fund. And donor-advised funds are often compared to private foundations, and they are similar in many ways, but organizationally they are quite different. With a donor-advised fund, a donor sets up an account at a sponsoring organization that is organized as a public charity, and that donor would have recommendation privileges over that account, but the sponsoring organization, the public charity, maintains full legal control over the funds. And the terms of the relationship would be contractually governed between the donor and the sponsoring organization. So, for example, the minimum distribution amount, the minimum funding amount, the number of advisors that can be on that account, those would all be in the contract between the donor and the sponsoring organization. And a donor advised fund can be a really great tool for the philanthropic clients who might have a large tax event in a particular year and who don't really want to deal with the administration of a private foundation. They want to give outright to their favorite charities, and so it's a really great tool. And you might have some clients who have both a private foundation and a donor advised fund. And that can be for various reasons. It can be for deduction purposes, some of those percentage limitations we've been talking about. It can be for anonymity reasons. So, for example, you might have a client who has a private foundation where they support national causes. So they give to the American Red Cross and the U.S. National Park System. But locally, they really don't want their name all over town, so they use their donor advised fund to support their local art museum. You also might have some private foundations that use DAFs, so they can be a really helpful charitable planning tool. Now, when donor advised funds were when they first came out, there weren't a lot of restrictions on them, there really wasn't a lot of IRS guidance, and there really weren't a lot of excise tax rules. So they were really seen as a private foundation without the headache. Since then, the IRS has issued rules surrounding excise taxes to donor advised funds. So we've listed some of them here, and some of them are the same rules that apply to private foundations. Some are more strict than those that apply to private foundations, and some are less strict. The IRS also has said that they're going to issue proposed regulations in the foreseeable future. At the end of 2017, they issued a notice indicating that they will be issuing proposed regs soon. We're not sure exactly what these proposed regs will say, but the notice did indicate that the IRS is struggling with how to issue rules on pledges and private benefit. So, for example, can a donor satisfy a personal pledge with donor advised funds?
Now we'll look at private foundations in more detail. So first, what is a private foundation? It's a charitable entity that's privately funded and privately controlled by an individual, a small group of individuals like a family, and sometimes by a corporation. Its primary purpose is usually to make grants to other non-for-profits, qualified individuals, and governmental entities, rather than directly running and funding its own programs. Private foundations can be structured as trusts or as corporations. Although private foundations are tax-exempt entities, they are subject to an excise tax on their net investment income. It is a 1% tax or a 2% tax based on a foundation's earnings in the year and grants that have been made. Unlike other charitable entities, private foundations are subject to federal public disclosure rules. The exemption application is subject to public disclosure in perpetuity, and 3 years' worth of annual returns are subject to public disclosure. I mention this rule because it's important to consider when you know your clients are looking for complete anonymity. Private foundations are also subject to various federal restrictions and excise taxes for failing to comply with those restrictions. These are the Chapter 42 rules, which you'll see listed on the slide. And although these rules are very thorough and the excise taxes that can be imposed for violating these rules can be high, they're generally not a problem for clients that want to create their own organization. Clients feel very comfortable operating within these rules, and they generally like the control and the freedom that private foundations offer. Private foundations allow them to make innovative grants. They can impose restrictions on grants that they make to charity. They can make grants directly to individuals in certain specific situations. Private foundations also allow clients to control their investments, and it gives them the opportunity to create a vehicle that can involve multiple family members, sometimes multiple generations, and create a family legacy of charitable giving. Lastly, private foundations can help individuals create relationships with charities, more so than some of the other techniques we discussed. An example of this is a recent board meeting I attended. There were 3 siblings that are involved in running the foundation, And they all actively were discussing which charities they wanted to support. They talked about grant proposals. They did their due diligence on the charities. They talked about site visits they conducted and reports that charities had provided to them. They were very conscientious about the charities they were selecting and the amounts of the grants they would be making. And they all commented on how the foundation allowed them to develop these relationships, and they felt that the foundation allowed them to have a greater impact on these charities. The greatest takeaway with respect to this tool is just making sure the funding plan meets the expectation of your clients, and also that your clients are aware of the nuances of administering and running a private foundation.
Another great charitable planning vehicle is a split interest trust. And split interest trusts include charitable remainder trusts and charitable lead trusts. They're not as widely used as, say, a donor advised fund or a private foundation, but when used in the right circumstances, they can be really successful. A charitable remainder trust allows a donor to provide an income stream to herself or loved ones, and after a time certain, the remainder goes to a charity or multiple charities. The payment is either a fixed amount or a fixed percentage, and it's payable either over a term of years or for life. And the donor can name a charity or multiple charities in the trust instrument, and those charities can be changed up until the donor dies. So a donor doesn't get a full deduction for the full value of what's put into the trust, but they will get an income tax deduction for the present value of the remainder interest, that portion that goes to charity. And a charitable remainder trust is tax exempt, which is really where the tax planning comes in. So a helpful way to use a charitable remainder trust is when a donor can fund the trust with low basis assets, and since the trust is tax exempt, the trust can then sell those assets, avoid paying the capital gains, and invest in maybe higher yielding assets and increase cash flow all around.
A second split interest trust is a charitable lead trust, and it's often considered to be the reverse of a charitable remainder trust. It operates for a set term, and payments are made to one or more designated charitable beneficiaries. At the end of the term, the remainder passes to non-charitable beneficiaries, such as the donor or the donor's family, or an irrevocable trust that has been established for the benefit of the donor's family. These trusts can be funded during the lifetime of the individual who's creating the trust, or they can be funded at that individual's death. They can be structured as grantor trusts or non-grantor trusts. And unlike a charitable remainder trust, charitable lead trusts are not tax-exempt trusts. They can be complex vehicles, so a great deal of planning needs to go into this technique, especially with respect to funding. So you might be wondering, well, what's a typical client that creates a lead trust? It's a strategy that's most frequently used by clients who are already charitably motivated, but they want to do some sort of gift tax planning or estate tax planning. And this is especially true when they don't need the income stream from the asset that's being transferred over to the lead trust.
Before we conclude, I want to go over charitable pledges. So you might have a client that comes to you as we approach year end and say, I want to sign this charitable pledge. Well, a charitable pledge is really a contract between an individual or some type of donor and a charity. And because it's a contract, it typically is enforceable. And so it's important when talking with your client about a charitable pledge to talk about the funding of that pledge. Where are the funds going to come from? Because if a client signs a pledge individually and says, I individually will pay $1 million to my alma mater, then the donor might not be able to satisfy that pledge with one of these vehicles that we discussed today. So it's really important before the pledge is signed to figure out the funding source and make sure that the contract reflects that. And if a client tells you that they already have made a pledge, then it's possible that some of these funding sources would not be available because they'd be seen as fulfilling a personal obligation with one of these vehicles. So for example, I can't sign a pledge saying I want to give $1 million personally to my alma mater and then create a charitable remainder trust and hope that my charitable remainder trust will then satisfy that pledge. Like anything in life, charitable planning is not a one-size-fits-all. So you want to really carefully tailor the charitable vehicle that you choose to the occasion. And this is the same when picking out a regular vehicle, right? So on the road to Hana, you want a Jeep so you can go off-roading. If you're going skiing with your family, you probably want a big SUV like an X5. You know, my favorite, a Mustang convertible if you're going to be on South Beach in the warm weather. Or, you know, if you paid attention to Dave's presentation, that Porsche. So we hope that this brief overview of charitable planning vehicles was helpful for you.